Hello and welcome to another episode of Purple Ventures Zoom video podcasts. And my dear guest today is Andrea Lauren, General Partner at Rockaway Ventures Fund. And we will be talking about venture investing in Europe in 2022. Andrea, may you please introduce yourself to the audience?
Hi, my name is Andrea Lauren. I am investment partner in Rockaway Capital and general partner in Rockaway Ventures Fund, which is a new ventures fund that we just raised in Central Eastern Europe and DACH. I've been working in the industry since 2017 when I joined the Rockaway team. But before I was a founder. Founded a small neobank here in the Czech Republic, and was the first CEO of Fundlit, which is an equity crowdfunding platform. Before then, I worked for 18 years plus in investment banking, mostly in London, in M&A advisory.
And now you're based in Prague, right?
Now I'm based in Prague, correct.
Mm-hmm. What is Rockaway?
Rockaway is a digital economy investor, a long-term investor that has been investing in this region since 2013, founded by Jakub Haverland, who's a tech founder and whiz kid to many people. We have started investing in ventures and actually continue investing in ventures through the fund. Then added some larger private equity transactions also in digital space, mostly consumer internet, e-commerce and related. And in 2020 also added a blockchain fund. So we are investing along several themes, several divisions, but we are sorry, but we are actually one of the investors with the largest scope within this part of the world. Our companies have been active in more than 8 countries in the region, first in Central Europe, then expanding down to Balkans and also German-speaking countries, DACH.
What startups does the Rockaway Ventures Fund invest into and why?
Right. Well, mainly we follow the same investment theme which we have had since the outset, because these are sectors that we understand, in which we have large operational experience, where we can check the assumptions, validate the business models. So consumer internet, mainly e-commerce and related last mile logistics, and then all the services that you can offer to customers within the same wallet, within the same customer experience, including fintech, for instance. We also believe in disruption of other sectors by using the same processes, the same logic, as we have seen, for instance, in e-commerce. So we invest in edtech or health tech as examples. So in general, consumer internet along these sectors. And as for the size of investments, we see ventures as a sector that's already sort of segmenting itself as well by the maturity of the profile of the companies. So we don't invest in the very, very early stage, the pre-seed, but focus more on Series A and similar. So companies that already have a proof of concept, they have a minimum viable product, they have revenues, they have some market recognition. And with those, we are then able to have also follow-on investments. So at least 50% of the money that we allocate to any investment opportunity, we reserve for follow-ons.
And geographically, where would you invest?
Geographically, again, following the same footprint where we are at the moment, so Central Europe and DACH, and we see quite a lot of activity actually now in the German-speaking countries.
By the way, what's your definition of a startup?
Startup is a company that has a team rather, that has a product, has a growth curve, and typically has some need for further cash flow injections. So we don't really measure it by the number of months or years a company is present, because there are cases like UiPath, for instance, that was already a company present in the market for 15 years before they pivoted to what made them a decacorn. But we see the team and the product as something which is driving some innovation, which has the growth path which is above average and exceeds what an SME would have. And in order to finance the growth, be it product innovation or geographical expansion, it typically needs external funding.
What are the key criteria you're looking at when deciding to invest into particular startup or founders?
Well, we are looking obviously at the quality of the team first and foremost, because a lot of business models are very elaborate, but then something goes wrong, be it external circumstances, typically the market perception, but even something that's completely out of your control. And the good team is somebody that can pivot, change tack, and step aside and reassess and relaunch. So this is what's actually separating winners from losers. But obviously then we look at a top-down, looking at the market size, the opportunity, the business proposition, the customers, the sales cycle, the costs associated with that, barriers to entry, and then from the bottom up we look at the quality of the technical solution, the standard risk concentrations, and risk is something that people will be looking at more and more, also in supply chain these days. And we assess both and decide, okay, this is a viable combination.
When you say quality of the founders, how much is that an art to assess that?
It's absolutely an art. Right? Everybody is different. There are founders that come from a technical background, founders that come from marketing, others come from finance. Not anybody nobody really can have it all. So you look at the good combination that corresponds to the phase of development of the product and the company. Obviously, when you are looking at Series B and beyond, you want a full C-level type of management. Every position has somebody attached to. If you are looking at a late seed, you will have 3 people out of 6, for instance, and the rest the company needs to grow into.
Mm-hmm. And what are the soft qualities. One is the hard knowledge and experience and competence, and what are the soft qualities you are looking at when you are actually investing into?
It's drive, it's ability, it's energy, ability to see bigger picture, being able to listen to advice, listen to adapt. But first and foremost, the ability to risk and go there with everything you've got. It's not a job. If you want a job, then you go to a corporate. This goes beyond, and the commitment of the founders needs to match it.
By the way, what is your pitch towards the founders?
Well, we are somebody who's been working with many companies, not just with the venture portfolio we have here, not just with the people that we invested venture capital in, but also the larger companies within our investment universe, the private equity type deals. And we have a very big network of people that we can pull in operationally, or we can pull in as business partners, for instance. Okay, you are a venture, you are proposing to deliver your solution into a B2B scenario where one of our portfolio companies can be the counterpart, and we can validate the quality of your solution and give you feedback. So it's not only about money. And when you have a business plan and it says, this is my marketing mix, or this is my cost of distribution, we can say, well, you are on par, or you are completely mismatched to the market, because we already operate in the market and understand it from practical point of view, not just, analyzing fancy Excel models. And this is something which is quite rare.
Andrea, what are the key milestones, moments in the startup founders or the startup investor journey together from initial term sheet until the exit liquidation event?
Exit liquidation event is long time ahead. We never look at the exit at the moment we invest. We assess obviously exit scenarios, but we know that from where we stand, there will be many further funding rounds. So we need to obviously be sure that the company is ready for that, because it takes a lot of time and resource from the management to fundraise parallel to building the business. But we do first quick assessment of the structure of the transaction, never try to be too aggressive on our funding round, because that will hamper the further fundraisings. And this is something that a lot of people who don't have this vision and experience actually face later on. The cap table is wrong, because they gave away too much of the company too early on, and now they don't have enough to offer to subsequent investors. So there is not enough left to the founders. So the question of their motivation comes to mind. So you need to prepare for this whole journey, and then obviously analyze the motivation of the founders to stay on, and for how long. Do they have a vision? Do they have personal commitment to the industry? Do they have any other commitments? How much dedication can you expect from them? Because they are what makes the company in the initial phases.
How hands-on or hands-off you would be when it comes to participating in the management of the company?
It depends very much on where we can add value. We typically, in the early phases, try to get a board seat or an advisory board in companies that have, a dual structure. So we don't really need to be part of the executive team. Actually, we prefer not to, but we want to be informed, and to the extent that our advice makes sense, we want to give it in real time. And then in subsequent rounds, when companies raising additional round C, for instance, and onwards, the early series investors typically step out or step back and allow the new investors to take the more active role. So to the extent you have anything tangible that you can offer, business leads, for instance, obviously you stay involved, but everybody when their time is most relevant.
Everybody talks about smart money, right? That added value of an investor towards the founders and the startup. How do you see that really being a key perspective for the founders when choosing an investor? And how oftentimes there is a real need for contacts, or the industry experience, or the both vertical or horizontal experience you have within Rockaway portfolio now.
Well, I think a lot of times there is. It's honestly one of the things which differentiate, because there's a lot of money in the market. But the smart money is what facilitates, the business growth. And if the business grows 3x or whatnot, then the story is self-fulfilling. So you need to be able to always pull in everything that you are able to, including contacts for further fundraisings, for instance. Typically, you want to help form a sort of circle of like-minded VCs that you can pitch the story to as well, that would follow not just the story of the founder and the company standalone, but also have some relationship with you as a VC, and would be able to co-invest with you. So, there's a lot of things that come to mind where you can help.
Mm-hmm. How oftentimes would you tend to co-invest in the initial rounds when you're actually entering the startup with other funds?
In the phase where we are investing in Rockaway Ventures Fund, it's more typical to co-invest than to invest as one investor only. This is a nature of the game. You want to have a round which combines several investors, where one is the lead. So one investor takes the largest position and runs the documentation. They negotiates the documents for the investment and the due diligence on behalf of all investors. But you share the risk and you share the expertise as well. So you would have between 2 and 5, sometimes even more investors in one round.
When you look back, what were the most fulfilling moments in your career with Rockaway when investing?
Well, I don't really want to emphasize one over another, but obviously for me a big thing was when I finally convinced Jakub Haveland to launch a fund, which is a third-party institutional product in a way, because up until then we were always tending to invest on our own books and co-invest with some partners ad hoc on a case-by-case basis in different companies, but nothing was sort of formalized. So it is a big step in a way to go and open a fund which has its own corporate governance, and you need to follow some processes and communicate regularly with investors, etc. But it is also for us a possibility to actually leverage our experience and go bigger in the market than we would have otherwise done on our own. So this is something which I'm very happy about, and I hope that the investors will be as well.
How big is actually Rockaway Ventures Fund?
Target size is 100 million euros.
Mm-hmm. And what percentage would come from Rockaway itself?
That's the other very important thing. We are not just the general partner, but also the largest limited partner. Rockaway is putting in 25% of the capital, of total commitments. In that way, we are perfectly aligning ourselves with the interest of investors.
Mm-hmm. And at the end of March 2022, how far are you with the fundraising?
Well, we started late last year, and right now we are finishing the first close, which will be announced probably in the next couple of weeks. So I don't want to actually pre-announce an announcement, but we decided to go stepwise and actually close with the first group of investors fairly early on, because we have a very full investment pipeline. So to balance fundraising and investing always requires a little bit of art, a little bit of coincidence, because investments actually come in their own pace. And we already have 2 which are warehoused and which we will be transferring to the funded cost, and 3, maybe 4 more in the pipeline that we are waiting for, and which are due in imminently. So we decided to match that with the first close and then continue for second close later this year.
From what regions would the limited partners come from? Is it similar? It's CE and DACH?
It is also some from the UK, for instance, but mostly it's investors here in the region. Mm-hmm. There are some mostly it's high net worth individuals. There are some institutional investors, but mostly it's high net worth family offices. So a lot of investors that have been following Rockaway for a while, that know us, that want to invest, and some have even invested in the blockchain fund. So it's people that know what we stand for and what returns we have been able to deliver so far.
Mm-hmm. And by the way, what would be the target returns on investment for the limited partners you are envisioning?
It's a tricky question, obviously. With venture, you never have sort of thresholds that you commit to. That's important to stress. But a benchmark for the industry is somewhere between 20-25% IRR. And if you don't achieve that, then you will have a hard time explaining yourself. Now, on our existing portfolio, so far we have 46% IRR, so I think we have done better than that. But obviously, there's a lot of factors which can impact how you will do going forward. So we hope that we will continue on the winning streak.
two factors which are actually influencing the venture capital world. Number one is for the past 2 years, COVID-19 was with us. Mm-hmm. How did you see impact of that on startups, founders, and also venture capital firms?
Well, it's many different impacts, and everybody impacted in a different way. But overall, if I were to generalize, it's better for the industry because for us, it's showed to everybody, even to disbelievers, even to the most traditional sectors, that digitalization is here to stay and gain. And obviously, as a big investor in e-commerce, we were ones that saw right from the beginning what critical impact e-commerce had in being able to deliver goods and services to customers that were isolated, forced to stay at home, and learned to shop for even things which they never before would be ready to online. And we believe that it accelerated digitalization of the economy by about a decade. We think that it has lasting impact, and it certainly propelled a lot of the startups in our environment forward. So from that point of view, obviously, we are a net beneficiary of this trend. But for a lot of companies on the individual level, if they were not already connected to investors and all of a sudden had to connect just online without being able to see face to face, it became more challenging to fundraise. How do you establish a trust with companies when you never even met? People have to learn. As I was saying, just a couple of years back, it would have been unthinkable for us and most investors to invest without meeting face to face with founders. And these days, and COVID obviously was a big disruption in that respect. People adapted, they went online, and we are now conducting a lot of activities digitally, and that's staying. But at the beginning, it was challenging for some of the founders, some of the companies to get traction with investors. And so individually, there would be some stories that did not benefit from COVID in the venture environment, no doubt about that. But overall, even the process of investing has adapted, and now it is for investors quite common to invest just by conducting virtual meetings, virtual due diligence, and docu-signing on contracts without ever seeing each other. From that point of view, even the American investors became more accessible to European startups.
Therefore, the European startup founders have more options, right, where to fundraise.
Until recently, definitely, that was something which we experienced as a huge net positive for the sector, also in this region, a net influx of capital, especially the U.S. investors finding a number of very attractive investment opportunities in Central Europe.
And at the same time, wasn't there like a serious inflation of the valuations, for example, which the startup founders are asking, 5 years ago versus now?
Well, as the amount of money has increased throughout the economy by intermittent but never really stopping quantitative easing. That was a part of our life for the last 15 years and more. There were, trends that I would argue went for all assets, not just for ventures, but there was really an inflation in value of all asset classes. And the capital markets, the publicly listed companies, they led that. And it's the big tech and their valuations that were driving also valuations of the startups because there was an embedded expectation on the exit values for a number of these, especially the later stage fundraisings.
Now to the second phenomena, which will probably be even greater, have greater impact and longer lasting impact, or we'll see, is the war in Ukraine, right, over the past month or so, which will for a long time, some of us were expecting that there will be some correction, right, on the markets and in the macroeconomy, and then it seems to be happening, right, with the increasing inflation, risks of stagflation. What will be the impact on our world?
I don't know. I am one of the people that expect much more severe impact, much more long-lasting impact than some of my colleagues, because as a domino effect, we have seen, for instance, even with COVID, a complete disruption of the global supply chain. And there will be more of the same. An already disrupted supply chain is further being derailed in a lot of unforeseen scenarios and pressure points. And there will be a spillover effect into virtually all products which we are consuming. And it's not just the inflation, it's the general inaccessibility of some products, which we already kind of foresee in some categories like automotive, but which will be far, far bigger and touch on everything. And the other thing, which is even more worrying, is the impact on food prices. Because that's not just for us who live in the well catered for and nice and cozy environment where we will just adjust our spending categories, but it will impact people for whom food is a major part of their budget and who will be facing starvation. And it's not just the wheat and corn that is actually produced in Ukraine and Russia. It is all the substitutes for these, including rice. And there's milk and dairy product inflation. And there is not just inflation, there's simple shortage. You know what happened when there was a bad harvest in Ukraine and Russia last time? It was the Arab Spring. So I expect a lot of blood being bled also elsewhere, not just in Ukraine, unfortunately. There will be, a lot of destabilizing of regions that were already torn by civil conflict and war in the past. And it's going to make a lot more people suffer. So, that's the background. For me, obviously, looking at investing universe, it's very difficult to see how that will drive the demand and availability of funds in Europe in general, and in Central Europe, obviously, which to American investors is very close to Ukraine. But also the demand of Middle Eastern investors who will completely reprioritize and focus on sectors close to food security and security period. It's a bad world we live in these days, and everybody has to make their own risk assessments. I would still hope that the asset-light, highly mobile companies that we invest in are relatively immune. But if Europe as a whole is not immune, then we will all need to rethink.
One somewhat related topic is, and it's another major long-term phenomena, is the global warming, it's the climate change, climate crisis, and related to that are the pressure on environmental, social, and governance of how we run companies, right? How that could affect the venture capital world?
Well, I think that ESG is something which is becoming more and more must-have, not an optional, within the strategic asset allocations of investors. And also for venture, this is something that people will need to pay more attention to. We, as a fund, have an active ESG policy. Active overlay on our investment decisions is, check for ESG compliance and see if we can work with the management of enforcing some principles. Monitoring, reporting, and even changing of attitudes, because in venture, there's limited resources, limited time. You have a small team that's running like mad, trying to get the product through the finishing line, and you don't have the luxury of, thinking about many things and, how you investigate and report them. But to me, ESG is something which is here to stay and is being highlighted, and not just the environmental. Obviously, environment is what most people associate with ESG, and it's a huge topic. And I will undoubtedly we will all see a big push to sustainable energy saving investments, especially since the supply of energy has become a geopolitical risk number one these days. But we will also need to look in general on the S and the G, the social impact and the governance impact and the management of risks in the supply chain, for instance. But also the transparency and the treatment of your stakeholders, including your employees and the customers, and the way you communicate, the way you behave as a company, as a team, is something which will be assessed. The trouble with ESG assessments is that there's so little measurable data and so few benchmarks which would actually help you. We are now working for the last half a year trying to assess, what criteria we should check consistently across the entire portfolio, which should be company specific, and which we can even measure, and what we can measure them against. And that's a process which will take a few years, in my opinion.
Thank you very much, Andrea, for our interview. What would you actually advise to startup founders who would consider going after investor money in 2022?
Well, you need to have the conviction, this is something which you yourself need to think about long and hard, because if you are serious about your company, about your idea, about your startup, you need to give it 100% for several years. And if you are not able to do that, then you will be struggling. Look at the product, look at the market you are trying to address. How many customers? How easily can you reach them? What competition do you see here? Is this something which you can pitch and deliver? Because one thing is a general idea, but if you have a hard time explaining what you do to your constituents, then perhaps sit back and rethink it. Endurance.
And my last question, what are your plans for the next 12 months, if you can share?
Well, more of the same. Obviously, we continue investing the fund. We'll hopefully find enough interesting targets and will help nurture our investee companies. It's also a full-time job.
Thank you very much.
You're welcome.
And to you, thank you very much for listening or watching another episode of Purple Ventures Zoom. I'm Jan Staniek from Purple Ventures. And if you like the subject of venture capital investing, startup world, and you want to educate yourself in the subject, please go ahead and subscribe.